right, so welcome to today's supply chain updates. So this is a segment where we'll give you all the happenings in the supply chain industry at the moment. Let's begin with Nigeria. The African Development Bank has launched a $2.2 billion initiative to boost agricultural processing zones in 28 states. This will reduce post-harvest losses and strengthen food security, they say. Meanwhile, Lagos is building what will become sub-Saharan Africa's largest food logistics hub in K2. This mega facility will support over 5 million traders and sustain food supply for over 10 million residents during times of scarcity. I hope Lagos knows something that we do not know. Across Africa, efforts are underway to improve medical supply chains. New partnerships are working to reduce high costs and end frequent stock outs of essential medical supplies. Now, on the global front, Apple is facing increased risk in its supply chain as US-China trade tension escalates. While Apple is shifting some assembly to India and Vietnam, duplicating China's efficiency remains a challenge. In UK, businesses are investing over $650 billion to bring supply chain home amid tariff concern. And finally, sweeping tariff announced by President Trump are disrupting global supply flows, forcing many companies to rethink their logistics strategies. That is your supply chain roundup for today. Stay tuned, be informed, and stay agile. We'll be right back after this short break. All right, so welcome back to the second segment of the episode and the show that's supply chain, where we talk supply chain, logistics, procurement, and everything in between. I'm your host, David Anaba. Today, we are diving into an incredibly important topic, which is third-party risk in supply chain management. Joining me is a distinguished guest. He is a lawyer and a compliance professional with over 16 years of corporate practice. He is a member of the editorial advisory board of the Society for Corporate Compliance and Ethics, a member of the editorial supervisory board of ACAMS, Today Europe. He is the founder of the redflag.ng, a foremost due diligence platform in Nigeria. We are honored to have Mr. Ibrahim Yeku here with us. You're welcome, Yeku.
Thank you for having me.
Yes. So this is a very important subject, and no better person can tell us how important it is when it comes to supply chain. Let us begin by laying a foundation. On a scale of 0 to 10, how risky is it to do business in Nigeria, in your own assessment?
Well, to start with, the assessment will be subjective, okay, right? And thankfully you said it, that in my own assessment. Yeah. Now, I think it's not be fair to just attribute figures or ratio to how risky it can be doing business in Nigeria. Yeah. However, if you are aware of the odds and the likely impediments that may affect your business success, then you can take steps to mitigate them. Right, so it's the amount of mitigations that you have in place that will determine the chances of your business success. Now, little wonder, some American companies cannot thrive in Nigeria. Some British companies cannot do well, exceptionally well, the way the Indian companies will do, the way the Lebanese company will do. It simply means that there's something they understand about this environment and how they are able to navigate, some of the dangerous points in the course of business transaction.
So
Right.
apparently you're saying that it's business dependent or it's cultural dependent. Is that what you're saying?
No, no,
How
no.
risky it is doing business in Nigeria?
It depends on your perception of risk in the first place. To some organization or individuals, if you say you can go into a country that is corruption prone, they say they don't have problem. They know how to navigate the environment, right? They don't have business, operating in difficult terrains where you don't have developed public infrastructure that may affect logistics and supply. Some companies and establishments have been able to find a way around some of those business hurdles or what you may see as impediment.
Okay, so I think before we go in now, what is it about risk? What is risk? When you hear third party risk, what do we really mean?
Okay, generally, organizations will have to transact with people, with other entities. Okay. So third party risks are those risks that organizations are exposed to as a result of dealing with other third parties, i.e. vendors, contractors, right, business partners, right, or any other associate they find necessary to go into collaboration with. Now, the risk that may affect the overall organization objective, right, are those third-party risks, you understand, arising from doing business with other persons or entity other than themselves. Now, no company or organization is set out to do business on its own.
True.
You relate with entities, you relate with vendors, you relate with contractors, and all these persons are necessary for you to achieve the desired business objective.
So all these people you've mentioned, you refer them as third party.
They are all third parties.
And they all come with their own risk.
Yes.
Why is it a big concern in today's business environment?
Yes. If you're not mindful of third-party risk or you don't have an appropriate third-party risk management strategy, the overall objective of maximizing returns of stakeholders or shareholders may be defeated. Now, one of the impacts of third-party risk, if not properly managed, is that there's an erosion of value. Right? Erosion of value in the sense that if you've earned yourself reputation for being outstanding in area of equality and fairness, gender equality in the case of women, inclusion, if you earn reputation for providing high quality goods and services, and you now engage third parties who don't appreciate some of the values that you stand for, i.e. third parties that do not see it necessary to deliver product or services that will help you maintain quality that you are known for, that may compromise you. It will affect the market perception of the kind of product and services that you offer. Right. So that's one aspect of the risk, and that's why organizations will have to take it seriously. Again, it affects the bottom line, the profit you make.
Okay.
Right. If you engage a third party that lacks the required financial stamina to execute contracts, and you've awarded contract to these third parties, and for whatever reason they are unable to discharge their obligation because of financial constraints, it will affect you ultimately. You need the services of the third party to satisfy your clients or the end consumers. So if the third parties you have engaged, the vendor, the contractor, are not forthcoming because of liquidity challenges, then it will affect your ability to deliver value for your own customer. And no income will earn from those.
Like they say that supply chain is the heartbeat of every business. Certainly. And when we started, you started by mentioning how difficult some companies may find it working in a space like Nigeria. What are the peculiar risk situations what are the risk situations that are peculiar to us in this part of the world?
Okay, generally, before you go into a country to establish a business, there are certain things that you need to know. Baseline, you have what you call country risk. You do a country risk assessment to determine whether or not you are able to operate in that country. For instance, if you are going to transact in a country that is under international sanctions, right? Or multiplicity of sanctions, not just the OFAC US sanctions, but you have the European Union sanctions, you have the United Nations sanctions. How do you hope to survive in such kind of environment? So you do a country risk assessment to determine the risk you'll be exposed to, i.e., what is the security situation in that country, right? If you can't guarantee security, then your operation cannot be protected, cannot be guaranteed. It will equally impact you. Also is regulatory risk, right? Now we are speaking generally to general framework of risk before you go into an environment. If you find yourself in an environment where the government is not stable in terms of policies, today the government comes up with one policy today, the next moment there's an announcement of another policy. Businesses cannot thrive in an unstable, regulatory environment. You need some level of regulatory certainty in order to operate. You understand? Because budgeting, planning will be based on the allowance or the allowances that the law has provided. But where you don't have such, then the business will not really thrive in the right direction.
So I think you've highlighted how important it is to assess the risk on a national level.
Yeah.
But let's bring it down now.
Okay.
Let's bring it down now to the vendors.
Yeah.
Now, when you do businesses, probably you've done your risk assessment on a country and then you decide you are going to do a business in that country. Or how do you now assess your vendors? When it comes to vendor onboarding, how do you now assess your vendors and what is it all about?
Okay, just to say that, what is the nature of the service or the services that you'll be providing will determine the kind of vendors you need.
Okay.
Right. And also in assessing your vendors, you want to know what will be their role in the entire value chain. There are critical vendors and non-critical vendors. Vendors that provide services, i.e. IT services that support your entire operation, particularly for businesses that are built around IT infrastructure. So you know and you're aware that for such kind of vendors that you'll be engaging, you need to pay particular attention to them. And you know what cybersecurity risk or data protection risk or infrastructure risk and business continuity risk that may arise from your engagement with that vendor. Now, when you determine what services the vendors will be providing, then you now decide whether or not the risk that will accrue from that relationship or the risk that you'll be exposed to. Some vendors will not, for instance, be dealing with public officials on your behalf. They are just technical vendors. They stay behind and they provide those services for you. But for vendors that will be going and be interfacing with public institutions or that will be making representations on your behalf, such kind of vendors will be exposed to anti-bribery and corruption risk, or they may expose you to it because when they are acting on your behalf, they are seen as your agent or representative. For any action or inaction that tend to violate the law, any act of bribery or corruption will be traced back to you, and that will expose you to corruption risk. Now, that is for vendors that are exposed to government officials or that will be dealing with government officials on your behalf. There are other vendors that will just be providing technical services, i.e. maintenance of vehicles, servicing of engines. Those ones, they have less risk. That what you need to consider in selection of such kind of vendor will be issues around competence, right? What is the labor policy? Are they employing persons who are fit to provide those services?
Those kind of services
that you require.
You know, for some companies, I see when I check their risk policy, especially third-party risk policy, I see they categorize vendors, and that would also determine the kind and the measure of mitigations that they recommend for those kind of vendors, and then they also have, for a lot of companies, and I know that you are familiar with a lot of them when it comes to compliance. What are the necessary compliance that must not be skipped when we or due diligence, per se, that must not be skipped when we are onboarding vendors?
I think I will take that to mean how do we manage the third-party risk?
Okay,
right?
yeah.
You understand? Because we have identified the risk,
Yeah.
right? And so how do we manage them? You said the first one, which is due diligence, right? Before you commence any relationship with vendors, with contractors, alliance partner, you need to know who the person is or who that entity, the persons behind the entity, what they do, how long they've been around, issues around their competence, ownership structure, ability to deliver on the services that you require. Those are basic, right? So at the basic, you have the due diligence where you do your KYC.
Yeah.
Know your vendor, know your customer, you have
customer,
all those
right.
documents or design. So first you must have a policy that spells out what are the things you'll be looking out for. What are the risks that may impact the business adversely? On the basis of that, you design your due diligence questionnaire, your KYC questionnaire, to elicit those information that will help you assess the level of risk you'll be exposed to should you decide to do business with that organization. So you design the form, you send it to the vendors, and you allow them to fill and submit back to you. So that is still part of the due diligence processes. Now, the outcome of your due diligence is to enable you identify the potential risk of doing business with a customer or with that vendor. And once you identify the risk, you assess the severity of the risk. What are the likelihood that this risk would occur or will crystallize? And what will be the impact on the business? So you can assign, based on your risk metrics, high risk, low risk, or medium risk. But what is more important is knowing what to do upon identifying the risk. You profile mitigation measures for the risk you don't want to avoid. Because you have the option of not engaging the vendor or not having any relationship with the vendor.
Yeah.
But in the business sense, it's not all vendors you can just work out on. They are essential vendors or vendors whose services are critical to your business success.
Business, exactly.
And you need to work around how to manage the risk exposure. And that's where you have mitigations. Now, the vendor's buy-in is critical in developing mitigations. You identify the mitigations.
That you work closely with the vendors.
Yes. So because you identify the mitigations,
mitigation
right?
measures.
And once you identify the mitigations, you get the vendor to agree that yes, if you do A, B, C, and D, our relationship will not be impacted.
We can do business.
Then we can do business together, right? And that's why it's necessary. So now, in determining that, you need to take into consideration risk tolerance and the risk appetite of your organization. How much of that risk, how much risk can you take, right? What is the threshold of tolerating the probability and the possibility of certain acts that may have adverse effects on you? Now, for instance, before this time, there's what they call the polluter pay principle, where you pollute the environment and you pay the fine. Now, for some organization, they see that, okay, well, what is the cost of polluting vis-a-vis
the fine that you are expected to pay? And
yeah.
then some contractors or vendors will just go ahead and then pollute and
you pollute
and decide to pay. Yeah.
And now this is where the understanding of high risk, low risk.
So it also rubs off on every other person doing business with that in terms of image. Doing business with that particular contractor.
Yes, certainly, and it depends on how you look at it. And I gave that example to illustrate what drives decision. Even when you are aware that there's a risk of being fined, but you know that how much is that? $1 million? Whereas from going ahead with that transaction or with the operation, you can make well above 500 million naira, dollars. So what becomes of it? So just willingly, you go ahead and you pay.
Now your viewers are listening to you, and they are thinking. So these are for organizations.
Yeah, very well.
These are for big businesses, and I have no business with that. And that's just to bring this show home, which is what this show is built to satisfy. Aside corporate organizations or structured businesses, how crucial is it for small and medium scale businesses, or even individuals, maybe enterprise, people who one-man businesses, how important it is. I, for one, have fallen victim of a bad business, of a bad purchase, because I neglected due diligence. So how important is it for individuals and also small and medium scale business?
Okay, I think to answer that, I'll start by saying you need to understand what the concept of third party itself. I've had cause to say this before, that anybody outside your organization that is not a member of your organization that wants to do business with your organization is a third party. I've equally had cause to say also that third party risk apply to families,
okay,
as much as small scale or medium scale organization. If you come down to the family level, and I'll tell you this also, that at the point that you are getting your maid, the house help, to come work with you, your security guard, these are third parties that are coming into your private space. You need to do a risk assessment. Do a proper due diligence. Know who they are. You understand, where are they from? What are their tendencies? Do they have criminal history? And all that. It helps you, right? So that's at the level, the basic level.
Basic
of the family.
level of
now,
an individual.
for an entrepreneur, right, for a small scale business, a lot of wastages, avoidable losses, can be prevented if proper due diligence or third party understanding of third party risk and how they can be mitigated is applied. Now, what does it require? Don't just jump at opportunity. You understand? Yes, some business proposals are lucrative, right? But then down the line, you may be exposed to financial losses. Also, don't take emotional business decisions. You need to cross-check. You need to validate. Check all representation or all propositions that is made. If someone made a representation that I'm the owner of A&A Limited, I do this, I do that, the onus is on you to go and check if those representations are true. Failure to do that, you'll be going into the business not knowing the party you are transacting with. One of the pitfalls is putting trust where none exists. And for you're doing business with somebody that you have interpersonal relationship with. And as a result of that, there's a business proposal that is coming from the person, and you decide to throw due diligence to the wind, and you feel that it will slight the relationship should you decide to, probe further, test the veracity of the statement the representation that the person is making. You understand? So that's at the personal, small scale level. For small scale, small medium enterprise, right? You have a third party management toolkit that can assist those small businesses. I.e., for every business you want to do or you are going into, what are the likely risks that you'll be exposed to? And it helps them to answer all the questions. If you want to go into cassava plantation, producing plantain chips, whatsoever, these are the likely risks. You can have supply risk, where the supplier refused to show up. We've had cause to discuss around what is happening in the northeast, north central, and the insecurity situation. Companies that source their raw materials and farm produce, for the agro-allied industry from that part of the country, they are being impacted negatively. They don't have access to the farm harvest. Why? Because the farmers cannot go to farm. There's insecurity. That becomes a supply chain issue. Right. So now, in recommending how to manage those kind of risks, you say, well, you don't centralize your supply. You try and diversify the chain of sourcing for some.
So I was going to come to that. In fact, you brought me to an angle that has been ringing in my head as you speak, especially for small and medium scale businesses, and that is in risk control and governance. It's very crucial that businesses have a standard. It's very important that businesses, whether it also applies for individuals and big businesses, that they have a standard, and that standard would help them to also control the kind of risk they are able to take upon themselves. How do you encourage businesses to go about setting up their risk management system, controls, and having a governance system?
Okay, I think domesticating the concept of third-party risk to small-scale business. I think that's where the challenge is, basically, because each time you talk about third-party risk, having standard or having policy, the picture you get is this applied to big organization, right?
Okay.
So now, in communicating how these small businesses can appreciate third-party risk, is for you to emphasize the potential losses. Communicate to them in a manner they will appreciate the message that you're passing. Now, for a small business, really no time for paperwork, really no time for documentations and policies. Even the worth of some of those business may not really accommodate those fine details. So what do? Is for you to help them adapt or implement software solutions embedded into their day-to-day operation, that in the course of having to engage or interact with the customer, the potential vendors, some of these issues will be flagged and they will need to respond to them.
Okay, so we will come back to that when we return. We want to go for a brief commercial break. Just hold that thought. Thought, because when we come back, there are certain areas in your contract, like clauses that must be embedded in those contracts. So put that thought and hold it. We will come back shortly after this message.